Hello and welcome to Accounting 100. This is Instructor Green. I'm going to provide a brief review right before we have our quiz. I'm going to supply the quiz online for you guys to take. Uh, but before I do that, I want to go ahead and just go over a couple of things. So let's just look at a few examples here of some things that you might see on the quiz. I just took a couple of examples. This first problem says on January 1st, year two, Grand Company had a $16,000 balance in the accounts receivable account and a zero balance in the allowance for doubtful accounts account. During the year, Grand provided $104,000 of services on account, and the company collected $97,000 cash from accounts receivable and uncollectible account estimated to be 2% of sales. Here it says the amount of uncollectible account expense recognized in year two would be what? Well, when you see a situation like this, we know that the uncollectible account expense is based on 2% of sales. We just go right to sales on account. Sales on account is $104,000. Shows us right there, $104,000 for sales on account. So we just take 104,000 times 0.02. That's going to give us $2,080. Okay, if sales was based on the amount of accounts receivable, then it would be 97,000, which is the amount of um well, 97 is the amount of cash that was collected from accounts receivable. So if it was based on accounts receivable, then it would be the $104,000 plus the $16,000. If it was based on the entire, you would take the 16,000 plus 104,000. That's the entire accounts receivable balance. And that's a totally different number. Here they're looking for just the service, 2% of the actual accounts that was written in this year. Okay, so accounts that were provided in year two was 104, not the entire accounts receivable balance, which would have been the 104 and the 16. Okay, so you just go straight to services on account 104, multiply that by 0.02. Next situation right here says Blake Company purchased two identical inventory items. The item purchased first cost $16 and the item purchased second cost $18. Blake sold one of the items for $24. Which of the following statements is true? Let's look at the first one. It says cost of goods sold will be higher if Blake uses FIFO. Well, FIFO means first in, first out. So we're going to sell the first one first. So we sell the $16 one. That cost isn't higher than $18. So the cost of goods sold would not be higher if we use FIFO. So that's not correct. Let's look at the second one. Ending inventory will be lower if Blake uses weighted average than FIFO. Well, if we use FIFO, ending inventory is going to be $18. Okay, if we sold one of the items. What weighted average, the average cost per item is going to be $16 and $18 divided by 2. So if we took 16 plus 18 and divided that by 2, that's $17. So your ending inventory would be $17 if we use weighted average and not 18 as it would be in FIFO. So this answer is correct. Let's see why the other two are not true. The dollar amount assigned to ending inventory would be the same no matter what. Well, we know that's not correct because they cost different. Gross margin would be higher if Blake uses LIFO. Well, no, because if he uses LIFO, then it's going to be $18 cost, which is going to bring our gross margin down. Because remember, sales minus cost of good is gross margin. So if our sales is $24 minus $18, that's giving us 6. Where if it was $24 sale minus $16, that's going to give us $8. So the gross margin will not be higher if we use LIFO. So the correct answer here would be B. Let's go down to this one right here. It says go ahead and calculate weighted average cost. Let's look at weighted average. Weighted average, we're going to start off with 100 units times 4. So that gives us $400 so far. Then we add 300 units times $4.40. That gives us $13.20. Then we have another purchase, so we're going to get 500 units at $4.60. Gives us 2,300. We had another purchase of 100 units at $4.80. Gives us $480. So if we add all that up, 480 plus 2,300 plus 1,320 plus 400, it's going to give us $4,500 total cost. And what we do with weighted average, we take the total cost and divide it by the number of units. Here we have 100 plus 3, that's 400, and another 500 units, that's 9, and another 100 units. So we're only adding up the units that was purchased. We don't worry about sales because all they're asking us for is the cost per unit. So sales isn't a factor at this point. So how much did it cost us to purchase these units? It cost us $4,500. How many units do we have? 1,000 units total purchase. So 4,500 divided by 1,000 is $4.50. Okay. This situation right here, they're looking for ending inventory if we were using FIFO. Same numbers here, I believe, but we're going to go ahead and use FIFO. Going to make a sale of 900. So if we make a sale of 900, that's our whole 400 is gone. All of these 300 units are gone. So that 1320 in cost is gone because remember, these are the same numbers as before. That 500 units at 460, all of those are going to be gone as well. So what's going to be left? Only the ending inventory, 100 units at 480 at $4.80. So $480 would be your answer. Okay. All right. Now let's look at ending inventory using LIFO. They want to know ending inventory using LIFO. Okay, and we're going to sell 800 units. So if we're using LIFO, we're selling the last ones first. We bought 600 units last. Because here's the whole situation. We purchased 500 units at $4 and then later purchased 600 at $5. So we're selling 800 units. So we're going to sell all 600 of those and then we're going to sell 200 out of the 500 batch. So what's left? 300 units at $4 a piece, which is $1,200. Okay, so those are just examples of LIFO, FIFO, weighted average. Cost of goods sold, you're just going to take the actual cost of the item. So in this situation right here, since we sold 800 units, cost of goods sold would be 600 times 5. So that would be $3,000. Okay, and then another 200 times 4, which would be $800. So cost of goods sold would have been 3,800. So cost of goods sold is always the number of units and that sales units times the actual cost. And then we just work our way either up or down. If it's LIFO, we're going up. If it's FIFO, we're coming down for cost of goods sold. And remember, for weighted average, cost of goods sold is also going to be the average cost of each item under weighted average. Cost of goods sold would be the average cost of each item times the number of units sold. Other things to remember for the quiz. We know that, for international reporting, LIFO is not allowed. For international reporting, LIFO is not allowed. Other things to be familiar with on the quiz are, and remember, net realizable value is the actual value that's expected to be collected from a receivable. So the receivable minus any doubtful accounts. So, and then other stuff, you have to read the chapter. There may be a couple of things from the chapter, but really this LIFO, FIFO, weighted average stuff, and then understand how to calculate the allowance for doubtful accounts. Now, remember, if there is a balance in allowance for doubtful accounts already, let's just say we have a $500 balance in allowance for doubtful accounts coming into the period, and we have $100,000 of sales, and we're estimating that 5% of those sales won't be collected, then we're going to say 100,000 times 0.05, which is 5,000, needs to be in uncollectible accounts. If we have $500 balance in there already, then we have to put 4,500 in to make it a total of 5,000. So our expense for that period would be 4,500. So remember, the expense is always what needs to go into the allowance for doubtful accounts for the current year. Okay, that's the actual expense. Gross margin. If we're trying to calculate gross margin, then we know that sales minus cost of goods sold is going to be our gross margin. So if our sales are, say, $80,000 and we've calculated cost of goods sold using FIFO, LIFO, or weighted average, we take that $80,000 minus that cost of goods sold, and that's our gross margin. Gross margin percentage is always going to be that gross margin divided by sales, and that's how you get your gross margin percentage. Okay. Remember when calculating weighted average that you're going to let me go to the weighted average situation up here. When we're calculating weighted average, then you're going to have a different weighted average after every purchase. And then when you sell, you're selling at the previously recorded cost using weighted average. Okay. All right. You should be ready for your quiz. I'm going to go ahead and provide that through Blackboard, so you can just go to the learning modules and you will be able to complete the chapter 5 quiz. Thank you.